So I was brought here today to talk to you and to Sue and pretty much her family about credit. Credit scores, it's pretty much how we're judged anymore for any type of lending, whether it's cars or rent, mortgages obviously as well. And really what your score is, it's a credit risk, right? So a bunch of actuaries come up with a scenario and they put an algorithm in and it spits out what your credit scores are. And to be quite candid, it's really simple. It comes down to like really 5 things. And that score is based on those 5 things. And about 35% of your credit score is going to be based on payment history. It's super important that you do make your payments on time. The next is going to be the amount owed. You're going to get a limit, right? And you're going to have a balance. So the balance is what you owe.
Right.
And if you are going to exceed between 30 and 35%, some say 30, some say 35% of what that limit is, it can bring your scores down even if you're paying on time. So an example would be, hey, I have a $1,000 limit and I go and I rack up a $400 bill. I'm at 40% of my credit. Even if I pay that off every single month and I kept on racking up $400, that could bring my scores down, right? Because it's always reporting that I'm using that amount of money. So keeping the balances down is super important. The next thing is going to be like the type of credit that you owe, right? So there's installment loans, there's revolving debt as well. So revolving debt's going to be credit cards. Installment loans are going to be cars, mortgages, student loans like that. Don't open up a lot of credit cards. Every time you try to open up an inquiry for a credit card or a mortgage or whatever at once, it can become a credit risk.